Whereas I'd actually love to see just boring companies add Bitcoin to their balance sheet. And if anything, I think value stocks that are kind of underperforming in this kind of winner take all market, they kind of slowly become a smaller part of the economy over time. One of the ways they can protect themselves is by owning a truly scarce asset, and instead of sending all their cash flows out as dividends or as buying back their own shares and stuff, they could be holding this asset. And so, kind of after years of waiting to see more companies bring this to market, a couple of us, a bunch of us decided, let's go and make this happen.
For years, Bitcoin adoption has followed a familiar path. First came retail investors, then institutions arrived through ETFs. After that, a growing number of public companies began adding Bitcoin to their balance sheets. But according to renowned macroeconomist Lyn Alden, the next major wave of adoption may come from a group almost nobody in the Bitcoin space is talking about: ordinary businesses. Just over a week ago, Alden and her partners at Bitcoin-focused venture firm Ego Death Capital announced the launch of Orange Juice Holdings, a new company backed by a Bitcoin treasury and armed with $40 million in initial funding. Unlike traditional private equity firms that acquire companies, slash costs, and eventually sell them, Orange Juice plans to buy profitable small and medium-sized businesses, improve their operations, hold them indefinitely, and use their cash flows to steadily accumulate Bitcoin. The idea is surprisingly simple. Thousands of stable businesses across America generate reliable cash flow every year. Instead of sending every dollar back to shareholders through dividends or buybacks, what if some of that capital was converted into Bitcoin? What if the local pest control company, its services provider, software business, or consumer brand suddenly gained access to the same scarce asset that institutions and sovereign wealth funds are racing to accumulate? In today's video, Lyn Alden explains why she believes the current Bitcoin treasury model is missing a crucial ingredient, and why Orange Juice could represent an entirely new bridge connecting Main Street businesses to the Bitcoin economy. But before we dive in, make sure to like this video, subscribe to the channel, and turn on post notifications so you never miss our latest Bitcoin and macroeconomic analysis. Now let's hear Lyn Alden explain the core thesis behind Orange Juice and why she believes cash-flowing businesses and Bitcoin are such a powerful combination.
The idea actually goes back to early 2025. We've been working on this for a while. This isn't just something we put together here this year. It's been a process to figure out the exact structure, how to bring it to market, and all that. And the main kind of focus was that there are a lot of treasury companies out there, Bitcoin treasury companies. One of the biggest criticisms against them is that they don't have cash flows. For those seeking kind of pure play levered Bitcoin approaches, that can be a plus in some contexts. For others, it's a minus. It certainly kind of adds volatility to the upside and downside. Whereas we viewed that if you have a stable cash flows, like operating cash flows, that provides a really good foundation that you can then use to build a Bitcoin treasury. If anything, I mean, ever since I saw kind of the first company come to market and add Bitcoin to its balance sheet, I've been expecting to see, a variety of other companies want to add some Bitcoin as well. But it's that they've actually been quite slow to do that. Most of the ones that have done it are kind of more Bitcoin adjacent type of companies, or they're springing up specifically to do the strategy. Whereas I'd actually love to see just boring companies add Bitcoin to their balance sheet. And if anything, I think value stocks that are kind of underperforming in this kind of winner take all market, they kind of slowly become a smaller part of the economy over time. One of the ways they can protect themselves is by owning a truly scarce asset. And instead of, sending all their cash flows out as dividends or as, buying back their own shares and stuff, they could be holding, this asset. And so kind of after years of waiting to see more companies bring this to market, a couple of us, a bunch of us decided, let's go and make this happen. The other reason is that there is a really big, strong demographic force of American business owners in general are aging. Many of them are looking to pass on the wealth that they've built. And there's a variety of options to them. One of the hardest things you can sell is a business because of the size and uniqueness of each one. And the main option for companies in that kind of small to medium size is private equity. And private equity serves a very important spot in the market. It obviously provides liquidity for these businesses that are otherwise quite illiquid. It could be very hard to find a strategic buyer. But many would say they have a negative reputation, and I think at least some of it's well deserved, which is, PE funds generally have like a 10-year life. The typical life cycle, what they want to do as a business is go in, and then within like a 3 to 7 year period, they generally want to flip it. So they lever it up. They cut costs pretty aggressively. They try to find ways to boost the multiple, and then they want to either bring it to IPO or otherwise exit that position to kind of optimize for that more short term gain, potentially at the expense of that long term success of that business. Studies show that companies that emerge from PE have a higher than average bankruptcy or financial distress rate, and it's because they're kind of in some ways hollowed out. They might otherwise have a good business operation, but they've been hollowed out for that kind of short term flip. Whereas it's rare, but there are other options, permanent capital vehicles that actually want to own that company roughly in the format that it's already in. Happy to make modifications and help them where possible, bring additional scale, but otherwise keep intact the legacy that they built and not have that kind of 4 to 7 year or 3 to 7 year mandate to flip and get out of it, which just totally changes our incentive structure.
So when you were describing the types of companies that you would be looking to buy, you described them as boring. So do you have in mind what types of companies you're looking at?
Yeah, good question. So basically, because a lot of us come from a venture capital background in the company. So we are partners at Ego Death Capital. So we, for example, invest in Bitcoin growth companies, tech companies, fintech companies. But the types of companies we're looking to buy with Orange Juice are, generally speaking, companies that are outside of this space entirely. Things that often have a physical, real world presence. That are kind of AI resistant. The kind of the classic PE examples like HVAC businesses, for example. It's almost a meme at this point that you leave Wall Street and go and you roll up a bunch of HVACs. But that's not really far off. When we start out, we are industry agnostic, meaning we're not targeting any specific industry. Instead, kind of in the early stages, we're interested in founders that specifically fall into a certain size category and that have an interest in preserving the business that they built. They optionally can even continue working at it, even as they want some liquidity. Maybe they want to keep their employees together. They want to keep kind of the soul of the company alive. They think it's better in those types of hands. And generally speaking, early founders are probably going to be interested in Bitcoin in some way. So they're going to be founders that just happen to also be Bitcoiners. Because early on in the strategy, we intend to buy companies with a combination of cash and some equity in our own entity, and that could be variable to the business seller. And so, generally speaking, we're looking for founders that kind of buy into the thesis as we see it.
At its core, Lyn Alden's thesis is built around a criticism that many Bitcoin Treasury companies have faced since their inception. While they offer shareholders leveraged exposure to Bitcoin, most of them lack a meaningful source of recurring operating income. Their fortunes often rise and fall almost entirely with Bitcoin's price. Orange Juice is attempting to solve that problem by starting with businesses that already generate stable cash flow and then using those earnings to gradually build a Bitcoin reserve over time. What's particularly interesting is that this strategy doesn't require every company in America to suddenly become a Bitcoin expert. Instead, Orange Juice acts as a bridge. Business owners who may already appreciate Bitcoin's long-term value can sell their companies into a structure designed to preserve their legacy while simultaneously gaining exposure to Bitcoin through the parent company. But to fully understand why Alden believes this model is superior, we need to examine her critique of Michael Saylor's strategy, the leading Bitcoin treasury company in the market at the moment.
What's your take on what's been happening with strategy recently?
So I think there's some valid criticism. I think my view kind of it shifted over time based on when you asked me this question. Because I've been a analyst and shareholder of MicroStrategy, so I analyze them. When I went on their February earnings call, I've been on two of their earnings call as an analyst. One of the things I focused on, the two main questions I asked were, are they going to maintain that existing USD reserve policy? So that 2 to 3 year of worth of preferred dividends. Are they going to maintain that policy? And two, we had seen actually at the Ego Death side in our venture capital arm, we had seen a number of companies looking to build products on top of STRC, um, uh, some of which could be levered. And so we that certainly gave me some red flags. Combined with just TradFi leverage. If you have one thing, with pretty low volatility with a high yield, and you can borrow at a lower yield than that, there's a lot of investors out there, either retail or institutional, that might want to try to lever that trade, and it comes with certain risks. So my second question was, are you monitoring leverage built on top of STRC? And would you kind of encourage or discourage that type of thing? In the months that followed, generally speaking, their USD reserve dipped below their 2 to 3 year guidance that they had given. And when they were gathering questions for their next earnings call, which I wasn't on, but I did on social media provide that question, which was, I point out that the dollar reserve fell to 18 months outside of their 2 to 3 year range, and if they have updated guidance. And then in the month or so that followed after that, it at one point dipped all the way down to 6 months of dividends, of reserves. And to their credit, it wasn't because they just aped into Bitcoin. They actually paid off one of their convertibles, so I would assume that they actually somewhat view that as a conservative decision. But I think kind of a chief, if I were to be critical of the company, is that they, generally speaking, when a company sets guidance, especially things that is in their power to do, the market generally expects them to follow that guidance. And so if there's kind of surprises to their operations, it can spook investors. So that combination of having, I think, a lower dollar reserve and then, leverage built on top of STRC, obviously that combination can create a very powerful volatility event. And then when that volatility event happens, investors can get spooked about the ability for the company to kind of continue supporting, the dividends there. I think that there are things you can be critical of kind of the steps leading up to that. Where I do like the announcement that they did, where they came out with that kind of updated plan, where now they have a board level kind of line in the sand that the reserve has to stay above 12 months unless the board authorizes otherwise. They also kind of authorized pools of like buyback capital, for some of their preferreds with an emphasis on STRC as well as potentially their own common stock. They've obviously been trying to make their my read of their kind of uh, selling of Bitcoin is partially that they want to show that that reserve can be tapped to pay for dividends and things, which unlocks obviously years of reserves, assuming that Bitcoin doesn't just totally collapse in value or something. And obviously, if in a perfect world, they don't really want to sell their Bitcoin. They want Bitcoin to keep appreciating. They want to be able to issue new capital with positive MNAVs, but they do have that option to fall back to. And so I think that there has been some criticisms around, say, the path that pens to get here. It would have been, I think, better just not to let the dollar reserve fall as low as it did. But I do think that the steps that they've done since then have been, about as ideal as I could consider. Like if I just found myself in that situation with you have 6 months of reserves, STRC just had a really big volatility event and it's still nowhere near its intended target. What steps do you do now? X, Y, and Z. I can't imagine what steps I would have taken differently than they would have since then, even if I might have advised different steps in the months leading up to that point.
Given this state of affairs, if you were strategy, what would you do?
Good set of questions. I mean, their latest actions have been to be building their dollar reserve. They actually, I think, announced one in the past 24 hours, or they got it up something like 22 months. So I think that's a reasonable kind of initial step, is just have this USD reserve. And some people are critical of it while it's building because it is generally speaking dilutive in terms of Bitcoin per share to be building that reserve. Obviously an ideal path is that you never dip the reserve in the first place, so that you might not have boosted Bitcoin per share as much, but then you're not also pulling it back. But again, you can't really go back and change the past. So if you are rebuilding the reserve, I think that's a reasonable first step. Two, if STRC stays in the 80s, they do have this authorization to buy it back. So that's an option that they can turn to, which I think can make sense. I also think a very reasonable approach at this current time is just a wait and see approach. It's still early. It generally takes a while to repair. Like you brought up, investor psychology around management. If they deviated from guidance, they have this new guidance. I think the market wants to see how credible that new guidance is. I think the fact that it's backed by the board further boosts the credibility. But the market, it takes time for information to go through the market. I think they want to see months and quarters of execution. Sometimes the best option is to not really change things and just keep doing what you said you would do and give the market time to adjust. It can also be the case that the market it just currently weights STRC at a higher risk and it wants a higher yield. And so it's pricing it down so that it has that yield. At least for new for investors that buy in. They have a couple of levels that they can pull, but I wouldn't say that they have to overdo anything. I mean, I think we're still in a Bitcoin bear market, so it's natural that just MNAVs are compressed and just overall demand for their products is relatively compressed, especially after they had that market scare, that volatility event. So I think just going for now and just continue to operate the way that they said they would is probably the key first step.
What makes Orange Juice so fascinating is that it expands the Bitcoin adoption story beyond the usual players. For years, the focus has been on retail investors, hedge funds, ETFs, public corporations, and governments. Orange Juice introduces another category entirely: privately owned. Cash-flowing businesses that may have never had a practical pathway into Bitcoin before. And that matters because the addressable market is enormous. Across the United States, millions of small and medium-sized businesses generate consistent profits every year. Many are owned by founders approaching retirement age who are looking for liquidity but are hesitant to hand over the companies they've spent decades building. Traditional private equity often prioritizes maximizing short-term returns and preparing businesses for eventual resale. Orange Juice is offering a different proposition: permanent ownership, operational support, and participation in a Bitcoin-backed structure. From a macroeconomic perspective, the timing is also noteworthy. Businesses today face an environment characterized by persistent currency debasement, rising debt levels, and increasing concentration within financial markets. Lyn Alden has long argued that scarce assets become increasingly important in such an environment. By pairing productive cash-flowing businesses with a Bitcoin treasury, Orange Juice is effectively attempting to combine two forms of value creation: real-world economic output and ownership of a digitally scarce monetary asset. Whether this model becomes a major trend remains to be seen. But if Orange Juice succeeds, it could provide a blueprint for a completely new phase of Bitcoin adoption, one where ordinary businesses, not just public corporations and Wall Street institutions, begin allocating capital to Bitcoin. In other words, the next chapter of Bitcoin's growth may not be driven solely by financial markets, but by the businesses that power the real economy every single day. If you enjoyed this analysis, be sure to like the video, subscribe to the channel, and turn on post notifications so you never miss our latest Bitcoin, macro, and market insights. Thanks for watching, and I'll see you in the next one.